market looks to be focused on slowing consumer spending and a sharp decline in inflation over the past several months. The Fed has actually received 2 PCE inflation reports since the last meeting. They show a sharp slowing of headline PCE inflation. That's to 4%, from 4% on a 3-month annualized basis to 2.1 now. Core came down from 5.4 to 3%. That takes out food and energy, obviously. Fed focused on the strong job market, claims running under 200,000 for 4 weeks now, despite many announced layoffs. The unemployment rate ticked down 1/10 since last meeting, and job openings remain elevated at 10.4 million. Market thinks the Fed ought to accentuate the positive of inflation coming down and embrace the negative risk to the economy. Not sure that's going to happen this time, guys.
I mean, just fight the Fed. Remember when it was don't fight the Fed? For years it was don't fight the Fed. Steve, just out of curiosity,
Morgan, I want to cut you off right there, but over the past several weeks, it has not cost you to fight the Fed. In fact, you've made money fighting the Fed. That's when they say don't fight the Fed because you'll lose money.
Point.
And maybe you will in the long run, but there's been no pushback, right? So Powell and company and his minions have not come forward and said the kind of hawkish things. I'm sorry to cut your question off, but I think that's an important point to make.
No, it's such an important point. And Steve, I guess it tees us up for the middle of the week and the expectation of whether Powell could actually come out and do that and bat down the easing of financial markets that we've seen recently, or whether there's an expectation that with inflation moving in the right direction, with a little bit of softness creeping into the labor market, that maybe not yet. Maybe it ends up making the bigger event March.
I think you're right about that. And I'm going to hope you don't think I'm wimping out on this. I'm taking the neutral of my 3 outcomes. I think the Fed, from what I've heard them say, is content to let the market make its own decisions about the outcomes for inflation and the economy. I think the Fed's concern, Morgan, is that the market doesn't misunderstand it. And I think the market understands the Fed, that if inflation is going to remain high, the Fed is going to hike and remain high. The market just doesn't have that same outlook on inflation or on the economy that the Fed does, Morgan.
All right, Steve Liesman, thank you.
Pleasure.
Let's continue the conversation. Let's bring in UBS Private Wealth Management's Allie McCartney and Wells Fargo Investment Institute's Daryl Cronk. Good morning to you both. Allie, you're here with us at Post 9. I'm going to start with you. Your thoughts on that conversation?
Well, this is exactly what we were talking about leading into this interview, which is I think this all has to do with perspective. The market has a perspective right now, or a sentiment, that it wants to go up. It's looking through the recession. It's looking through what the Fed is telling it. Even though the decrease in inflation and the better comps that we're seeing are because consumer spending is going down, the market seems to want to rally. We've gone from pricing in a recession at about 50 to 60% to about 10%. So I think what was just said is exactly the point. I don't exactly understand why the market is fighting or fading the Fed so consistently right now, but you can't fade the Fed long term and you can't fade the market. And the market is going up, right? The market is growth on. We're going to get out of this. I was telling you that of the laggards in Q4, relative to the best performers in Q4, there's a 15% spread going on. So yes, if you're going to get paid to fight the Fed and go with the market, go with it. But I wouldn't be confused that we've left all of the anxiety and the uncertainty behind, and it's time to long-term dig in.
So then how are you advising clients in this environment then?
We still have a very healthy amount of cash, especially when you're being paid. And for private clients, you're being paid incrementally to take U.S. debt in the form of short-term treasuries as opposed to longer-term U.S. debt and or corporate debt. So we're waiting for that to change. We're starting to lean into emerging markets, equity and bonds, and a lot of that has to do with the view on the dollar and the relative strength in value stocks that we see is a preponderance of other markets. And we are still solidly in things like alternatives that are neutral, macro funds that can and did largely last year protect on the downside when everything else went negative.
Daryl, I want to bring you into this conversation. Your thoughts on this topic, especially since it's going to be such a big week with so many data points coming from so many directions.
Yeah, that's exactly right, Morgan. I'm going to take a little bit of the other side of this conversation or argument and say, look, when we look at this latest rally, there's definitely some tea leaf signs where we're starting to show some exhaustion here. The 20-day, the 50-day, and the 200-day are all coiled tightly in a spring right now, kind of right next to each other, which usually suggests they break out to the upside or downside. what's interesting about this rally is, it's coming from places that are not as high quality. Some would argue junkier places of the market. You're also getting, gold is up as much as stocks are this year. And all month long, even as this rally has happened, the 2 to 10 yield curve inversion is still flat on 70 basis points. It hasn't moved a dime. So I'm not sure there's as much quality to this rally. A lot of this is January effect, short covering, and just actually some of the leaders that got heavily sold into tax loss selling in December, resurging in January. So we got to break out to the upside before I'm convicted that this is not just another bear market rally.
Hey, Daryl, I wonder, the big debate right now as to whether or not the impact of monetary policy tightening is working into the economy faster than in the past. Because if it is, and we're still seeing the kind of growth we're getting, then that says good things about the economy's ability to withstand tighter conditions. Do you think we have an answer on that yet?
Well, certainly, the lag effect, which is 6 to 9 months, we're just now feeling the June, July 75 basis points. We've yet to feel the 75 in September, the 75 in November, or the 50 in December. So there's a lot of tightening that still has to come. Interestingly, it's a great point, Carl, because if you get below the surface and you look at the economy right now, the economy I don't think is running as healthy as people think. You look at M2 money supply for last month, it contracted $150 billion, which is a 7/10 decline, which is the largest monthly decline we've seen since the 1950s. So money supply is contracting quickly. If you look at just Friday's income and spending numbers, real consumption declined again in December after an unexpected decline in November. So the economy finished the year weaker than people expect, which on consumption, which is key, you lose the consumer, you lose the economy. So I think there's some data there to suggest that conditions are perhaps tighter under the surface than many people realize.
Hey, Ali, I just want to end with you on sort of a bit of a side note here, but you mentioned alternatives, and I'm always curious as to what you're seeing there. On private equity, there's some questions in terms of marks. There's private credit, so many growing products still. How do you view that? Because you mentioned that it is something you see as part of a portfolio.
Yes, so we have had a significant amount, especially of private debt in the last number of years to replace what used to be sort of the healthy staple of fixed income for private clients. You asked the right question. I don't think we're there yet. I don't think we're close to there yet, right? So if what was just said is that it takes 6 to 9 months for financial tightening to be in the economy from a liquid perspective, let's say it takes 3 to 6 quarters for it to get into private markets in terms of marks, et cetera. And I think what you're finding in terms of private markets is because there's been so much cash and so much funding for so long, a lot of these companies that would normally have to come back and tap the private equity and debt markets are still flush with cash. So they haven't had to have that moment of reconciliation. And so that still has to happen. And that's why, as much as we don't want to fade the market and we want to take what we're getting, I think the digestion process that we're going through has hardly begun. And down to all of those points that were just made about the negative consequences and data from ending last year, let's see what we actually see when we see first quarter earnings from this year, and then let's start leaning in with a much more sustainable bias.
All right. We're going to leave the conversation here, and quite a conversation it's been. Our thanks to Ali McCartney and Daryl Cronk this morning. As we head to break, here's our roadmap for the rest of the hour, including the EV pricing wars, Ford taking a page out of Tesla's book, cutting costs on one of its electric cars. We've got those details.
Plus, we've got technology stocks pulling back a bit today. But of course, many names such as Meta, Amazon, NVIDIA have been on quite a tear for January.
And we'll check in with NFL super agent Drew Rosenhaus